Hi, it's Raoul. Guess what? I can't believe, but we're turning 10 at Real Vision this September. I can't believe it's a whole decade of democratizing the very best financial intelligence and building this kind of super community of finance, including the super platform of finance. And to celebrate, we're throwing a virtual party on September 27th at 12 p.m. and you are on the guest list. It's free to join, so don't miss out. If you're not a member, you can sign up at realvision.com/free. We've also got a trade ideas competition where you can flex your market smarts, plus some exclusive limited birthday merch and much more planned for September. It's going to be a lot of fun. So sign up, realvision.com/free, and we'll see you at the party, September 27th at 12 p.m. That's realvision.com/free.
Welcome back to Real Vision. I'm Ash Bennington. We're joined today by Komal Sri-Kumar, President, Sri-Kumar Global Strategies. Sri, welcome back to Real Vision.
Good to be back with you, Ash.
Sri, you're one of our favorite guests here at Real Vision, one of the viewers' favorite guests here at Real Vision. It's always a pleasure to have you with us. But boy, I couldn't picture a better guest for today. We are in a macro moment. It's Sri-Kumar time. Tell us, big picture, 50,000-foot overview. How do you see these markets shaping up right now?
The 50,000-foot view, Ash, is to say that inflation is still not vanquished. It is still quite a bit higher than the Fed target, even though we have come down from the 2022 levels. And on the employment side, despite all the noise being made about the latest jobs report, we are still relatively healthy on the jobs market as well. In other words, the economy is softening. The employment growth is not as great as it was a few months ago, and the inflation is higher than target. Now, if I were to tell you that, you would say, isn't that what the Fed wanted? They wanted a softer economy, lower inflation, and they don't want the economy to crash. So when that is happening, what should you be doing? Nothing. On the other hand, the Fed has the scenario that it wants, a softer economy, lower inflation, but still inflation above target. And they are debating whether to cut by 25 or 50 basis points next week. That's the part which I don't understand. Are they catering to employment? Are they catering to inflation? Or are they catering to the future employers in the private sector? Because once they leave the Federal Open Market Committee, they need jobs. Are they interviewing right now? Or are they conducting policy? That is my concern as to how the members are operating.
And this is always the challenge that the Fed and global central banks have, trying to steer between the Scylla and Charybdis of maximizing job creation while keeping inflation at stable levels. You sort of begin to frame this issue out with this open question. Let me ask you this. What do you think they're thinking right now? Obviously, as you point out, the talk right now, the speculation on the street is whether it's going to be a 25 or 50 basis point cut at the next meeting next week. You hear all of this. It's almost like the Oracle at Delphi. One of the Fed board governors gave a speech where he said, it's softening, but not deteriorating. And I was scratching my head a little bit about that characterization, trying to understand how you can be softening without deteriorating, what exactly that means. Is this just a case of global central banks wanting to eat their cake and have it too?
At least in the case of the Federal Reserve, that's what it is. And that's what I stated in my latest write-up, that it's a case of having the cake and eating it too. So in other words, you have a softer economy, you should just leave it that way, but then you also want a very vibrant growth in employment. So you cannot have both. You essentially have agreed to cut down in terms of what you're going to have. Now you said, excuse me, now you said, Ash, what do you think they must be thinking? And I think here, think about, again, a hypothetical member of the Federal Open Market Committee. He or she is being faced with a lot of inquiries for meetings, discussions, and think about how many people earning $25,000 a year or less that they meet on a regular basis to get their views on the economy, how their life is going, compared with the people who are hundreds of millions of dollars in net worth, more than $1 billion in net worth in some cases, and they talk to them. Who do you think they talk to them the most? It's the latter. So while you have Jerome Powell coming to every federal open market committee, he sheds tears. I almost look like I should help him out with some tissue, because he begins by telling us how concerned he is by the pain suffered by the lower income family from inflation. That used to be the refrain. And then, of course, you can go on to do whatever you want. You can do things where you don't allow for inflation to come down further. And that's where we are. The Fed is not really catering toward the lower income people, despite all their protestations. They are not catering to bringing down inflation, which is part of the mandate. The concern, the focus has been on, again, stimulating the equity markets up, which is not part of their mandate. So those are all the concerns I have collectively with the way they are conducting policy. You talked about the global side, Ash. In the case of the European Central Bank, at least they have more reason to be lenient. They have tremendously brought down their inflation rate, number one. Second, the Eurozone inflation is of a different quality compared with the Federal Reserve inflation. In Europe, it was caused largely by energy prices, the Russia-Ukraine war, and as a result of which the price of natural gas shot up. And Germany, the largest economy in Europe, is a big importer of natural gas from Russia, as is Italy. And the two of them have had to adjust very fast and find other alternatives, and inflation went sky high. When that inflation came down, natural gas prices came down, then what you had was that inflation also tumbled and came down to very low levels. The Fed's problem is the inflation is caused by a doubling of the Federal Reserve's balance sheet between 2020 and 2022. And keep in mind that even in 2020, the Federal Reserve balance sheet was bloated. But as soon as COVID came, they doubled it again, took interest rates down to zero, even though we had a total of $2.8 trillion worth of fiscal stimulus from the final months of the Trump administration and the beginning months of the Biden administration. So when you say that to the Fed, Jerome Powell tells us his job is to manage monetary policy. It is not to look at fiscal policy. But that is economic policy ignorance. You cannot be the head monetary policy maker without also considering how stimulus the fiscal policy is, which he failed to do, and we are paying the price for it.
Yeah, that's very well said. You talk about the loose monetary policy during the COVID period, in addition to all of the additional fiscal stimulus sloshing around in the system. I think it's easy sometimes to lose track of just about the impact that this has on workers, on families here in the United States. One of the things that we've mentioned is that it's trending more toward 3% than 2%. That may not sound like a huge difference. I just built a little data series here on the fly, looking at CPI for all urban consumers, and I indexed the price level to December 2019. We are at 121% of where we were in December of 2019, meaning roughly 20% of your purchasing power has been wiped out if your income did not change. Framed in that sense, maybe just stated slightly differently, you get a sense of just how devastating the impact can be of consistently rising prices over time in an economy.
Absolutely correct. You have had a significant increase in the price level, and your income level, the salary level, has simply not kept pace on average. So with the result, even when the administration tells you today that inflation is approaching the 2% target, that doesn't mean that the price of eggs have gone down to the level of December 2019. They are still elevated. The price of a lot of essentials are elevated. 2019, you were thinking of buying a house. You're a first-time buyer, and the mortgage rate was tolerable, low. And in 2020, 21, they lowered the rates so much that the demand increased. And as a result of that, eventually they had to increase the rate, the mortgage rate went up, and the housing affordability is now at an all-time low. And people who are the young people, the 20 to 35-year-olds who are trying to buy their first home, they are simply out of luck. And inflation coming down to 2% is still not going to achieve their goal of getting their first home. So all of that takes into account, as you said, Ash, it's the difference between the flow and the stock. The flow refers to the pace of change of inflation. That has slowed. The stock, namely the level of price, is higher and it's not going to go down to the old level.
Right. So many important points there. And by the way, not only has average wage growth not kept pace with inflation, most people are not average. In other words, it's not evenly distributed. If you're someone who's just been in a job for a 5-year period, for example, you probably don't have the power, pricing power with wages to go to your employer and talk about the pain. So obviously, this is something that's been very difficult for consumers, for families here in the United States. You also touched on a really important point, which is the distinction between the haves and the have-nots in this market in terms of those who own their own homes versus those who don't, people who locked in lower rates years ago and have seen the benefit of that increased appreciation in housing prices. It has been a significant determiner of how you're faring in this economy.
Absolutely. And it also determines how you're going to behave in your spending patterns. If you are part of the lucky ones and your home appreciated because you already owned a home in 2019 and you have enjoyed significant appreciation in your home price and you're able to liquefy it to some extent, you are now a big spender. On the other hand, the first-time home buyer who I said is out of luck, he or she is unable to keep pace and they are left behind. So one result of this is that income inequality has increased. That's the point that you referred to. Think about what happened also after 2008. Ben Bernanke, chairman of the Federal Reserve, told us that by lowering interest rates to zero and having quantitative easing or an increase in the Fed's balance sheet, he was going to boost the price of asset values. You and I will feel richer. We will spend more money, and therefore we will make the economy grow faster. But look at what happened. The economy did not grow much faster after 2008. On the other hand, the low-income earners who could not invest in the stock market, or the retired people who could not take the risk in the stock market and had to go for the bank deposit interest income, they were all left behind. And those people who invested in risk assets did fabulously well during the 10 or 12 years after 2008.
Yeah.
So that is the issue here, is when the Fed intervenes, it changes what we in economic terms call relative prices, the price that you charge for what you sell relative to the price that I charge for what I sell. And when there is a change in those relative prices, the income inequality also increases, and that's what we see. And whether the Fed meant to do that or not, they have essentially increased the social pressures coming from the income differences.
You want to unfuck your shit? This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Sri, these are such important points, and you make them so eloquently. I think you give voice to the sense that a lot of people have, a feeling that they have, as you say, to be left behind in this market, in this economy. Such an important and powerful point to make when so many people are feeling and experiencing that in their lives. But I want to shift gears here and talk a little bit, not about so much maybe what should happen or the challenges that people have, because I know that that's something that they feel for certain. But talk a little bit, Sri, about this bind that we're in right now, what you think will happen next, given the opportunity set, the option set that the Fed has today, and what its impact will be on risk asset prices.
What I think the Fed is heading toward, Ash, is the fact that they want to avoid anything like a crash. They want to avoid a credit event, which they may or may not do. But the fear that the Fed has is the repeat of the March 2023 regional banking problem. Can that happen again? Yes. When you have these kinds of swings in monetary policy, you also give rise to volatility in the market, and that in turn can cause all of these disturbances. Look at what is happening here. Commercial real estate is again the focal point of a number of trouble, especially office space. The Federal Reserve, there's nothing that they can do about it because it was caused by the fact that interest rates went sharply down and then up again. And commercial real estate was the favorite investments in 2020, 2021. And when people stayed away from their offices, suddenly it went essentially into the doghouse in terms of the attractiveness. Now, what the Fed, you asked me, what should the Fed do under these circumstances? I have long believed that the Fed should avoid the ups and downs of the policy by essentially following rules as to what they are going to do. And again, my old professor, John Taylor, now at Stanford University, had something which has come to be called the Taylor rule. Namely, look at the inflation, whether inflation is above or below your desired target, accordingly change interest rates. Look at where growth is relative to what you, meaning the Federal Reserve, want it to be, and is it higher or lower? Adjust the interest rate. Otherwise, don't do anything, go home. Why doesn't the Fed do that? Because it means we don't need any of them. A computer can do the job based on these principles. But the Fed is a bureaucracy, and they want to intervene, and they go in and out to show that they are active. I usually say that I will pay the Federal Reserve voting members more, increase their salary, give them a bonus if they don't come to work and stay at home. And by coming here and doing all of this work, they only make the situation worse. And that's what the Fed should be doing. Is it going to happen? The chances of that happening, in my mind, is zero. But you asked me what they should do, and that would be my recommendation.
Sri, one of our viewers, Paul E., just anticipated exactly that question and said, Sri, what is the solution, or what can be done to straighten out this economic mess, and how long would it take?
In order to straighten out the mess, I think they need to go through a crunch first, because the Fed policy is not in tune with having the economic growth go at a steady pace. Why is that the case? Economic growth comes from labor force growth, how fast your workforce is increasing. Second, it comes from productivity change. You used to make 5 widgets an hour. Now you're making 7 widgets an hour, each one of you. That is an improvement in productivity. Those are the two ways in which the growth can pick up, not by increasing the money supply. Again, look at one other comparison. When you have quantitative easing and you double the money supply, the plumber does not become a nuclear physicist. The plumber is still a plumber, irrespective of what the money supply is. So money supply should restrain itself to thinking about inflation and keeping inflation at a reasonable level, and follow policies which are structurally advantageous to help employment, to help productivity growth. And then the economy can grow at 2.5% to 3% on a steady basis. You can avoid the ups and downs, And that will also foster more private investments. And that would be my recommendation to the viewer who asked you the question.
Sri, let me touch on something else because you mentioned it earlier. We talk about the two official goals of the Fed, maximizing employment and stable prices. You mentioned this notion about how the Fed may or may not be targeting U.S. equity market performance specifically. It's been an unusual year here. For example, I'm looking at a chart of the S&P 500 right now. Obviously, some significant divots in this chart, but it's up nearly 15.5% year to date, trailing 12 months up almost 22%. You made reference to this idea that perhaps it begins to resemble this idea that maybe the Fed is implicitly targeting U.S. equity markets. I know that Julian Brigden and others have made this point and said essentially the U.S. economy has been so financialized over the last, say, 20 years that the Fed simply just doesn't have any choice because of the intense correlation between US equity market valuations and labor markets. How do you think about what may or may not? And we're looking in from the outside and kind of speculating based on the actions of what may be happening here at the Federal Reserve with regard to equity markets.
Those are great questions, Ash, and a lot of interrelated questions. Let me try to tackle them, at least a few of them. And if I miss any of them, please do come back and ask me, and I'll be happy to expand on it. Yes, the US market is financialized, to use that expression, and the Fed is again looking much more at the stock market than it is looking at salary growth or employment growth. The reason is the way in which you get out of it is not to do more of it, which is what they have been doing in terms of their policies. What has to happen is, again, as I said, have a disciplined rule for growth in money supply, changes in interest rates, which are linked only with those two measures, inflation and employment. Put them out in the public. Let everybody know what you're going to do. No suspense. Second, what the Fed calls now as forward guidance, I've written about it and called it forward confusion. And the reason is they don't adhere to what they said they were going to do. The most recent case, December, Jerome Powell told us that we were going to have imminently rate cuts in 2024 at the start of the year. There were going to be several of them. We are now in September. Until now, we haven't had any cut in interest rate. And the reason is inflation did not keep coming down as it did in the final months of 2023. When Jerome Powell has been so wrong on forecasting inflation going all the way to going back to 2020, why talk about inflation coming down again and in terms of linking yourself to that measure? So to make it less financialized, I think the Fed ought to be looking at only the two measures that it's part of the mandate. And then when the markets move up or down in result, the Fed, again, would go mechanically every month if he still wants to make a press conference saying, my statement is the same as a month ago. If you want, I'll play a playback of what I said 1 month ago. It's the same thing. We are concerned about these two things, and we are not going to change. If that happens, it will take a few months for the stock markets to adjust, for the investors to understand. But once that happens, they will know that you don't have a Powell put anymore. The chairman is no longer your friend. It looks like finally you have somebody who is concerned about inflation and employment alone, exclusively. And to reach that, there will be a period of turbulence in the stock market, and the Fed has to tolerate that. The administration in power will have to tolerate that, and then you switch over eventually to a more stable system. That would be my suggestion for how you can less financialize a system than it is today.
Sri, I'm going to ask you to take off your normative hat for a moment and put on your empirical hat. I think it's so important to talk about this so that people can understand these issues and understand really what's happening under the surface. And I think give name and give voice to many of the feelings that they have that's difficult to articulate for people who don't have your formal training in economics. But let me ask you this: what do you think will happen next? What is the Fed likely to do? I don't know, Brian, if we could pull up that chart of 10-year US Treasury yields. You look at this, very clear when you see a 1 year peak in Treasury yields around 5%. We're now trading on a yield basis near the lows, around 367 basis points on my screen right now. Obviously, markets pricing in cuts to federal funds rates and more accommodative monetary policy. Sri, when you look at the game board today, what do you view the most likely scenario for the Fed to be as we come into this critical meeting next week?
You asked me to deal with the empirical rather than my preferred way. So let me do the empirical, but I'm not going to stay away from my preferred way, Ash, because you need to see the contrast. Empirically, what is going to happen? The Fed has essentially promised a 25 basis point cut. They have said that they are data dependent, but they are not. Come what may, they are going to cut interest rates. We have crucial inflation figures coming this Wednesday and Thursday. Do they matter? They don't matter. Whatever the number is, the rate is going to go down next week. Second, they told us that they are concerned about the labor market. But again, initial jobless claims are going down for 3 weeks in a row. The unemployment rate has gone down, not up. The labor force participation rate has stayed steady at 62.7%. These are all signs of strength in the labor market, which are essentially being ignored as the Fed gets ready to cut rates in a few days' time. So empirically, what is going to happen? They said 25 basis points. What's the market doing? The market says we can make the Fed do our bidding. The Fed is at our command. We can change it. And the 25 basis points a few weeks ago, that expectation caused stock markets to rally. Not anymore. 25 is in the market, very much so, that they want 50. So if you do 25, come out with 25 basis points Wednesday of next week, the reaction may well be a downer because we always anticipated 25 and it happened. We really want a 50. And if the stock market goes down, Jerome Powell is going to be watching what happens between 2 p.m. and 2:30 p.m. Eastern time. And if the markets go down with a 25 basis point reduction, 2:30, you can expect him to, in answering questions from journalists, he's probably going to say, well, expect more cuts to come and the market can go up again. That's what is happening. Empirically, I think that's what is likely to happen. The Fed wants the market to continue to stay connected, expect more rate cuts, and therefore they will come through with it. What ought to happen, I told you I can't leave you without my suggestion. I think they shouldn't cut at all. You go in and say that the inflation rate is above our target. Employment numbers are still healthy. Federal Reserve Bank of Atlanta GDP now numbers range between 2% and 3% growth in the current quarter. That is not a recession when you're growing at 2% plus. And therefore, given all of this, we in the Fed are happy that things are going well, and therefore we are not going to change anything. We ain't going to fix anything that isn't broken. That's what they ought to do, but I told you what they will do.
Sri, the questions are coming in fast and thick right now. This conversation is obviously very much connecting with our audience. Here's a question from Philip T that speaks directly to the heart of your point. What will happen to the lower income folks if the Fed allows inflation to stay at 3% to support the asset markets? Obviously, someone who's very much on the same page with you in terms of the thesis.
Yep. If the Fed allows inflation to be at 3%, and they do so by cutting interest rates and promising more rate cuts to come, The stock market investors are going to be doing very well. But you asked again from the viewer's question, Ash, what will it do to lower income groups? They are not going to benefit from it because if they are not investors in the stock market, they are not going to get the benefit of the Federal Reserve policy. So the income inequality is going to worsen, and you're going to see the inflation hitting more in the cost of essentials, and they are going to suffer more not having the benefit of appreciation of equity prices to help them out to deal with the higher price of milk or eggs. So you again have a divergence. If that's what they do, the lower income groups suffer, and the higher income groups are going to have lots of ways to make themselves better with inflation. That's the reason why inflation is persisting. I'm going to extend your viewer's question one further step. The Fed is acting in the current manner because they don't really have to care about the lower income people. They're not there. They don't talk to them very much. They're not the one appealing to the Fed. And the higher income groups are cheering them on because the risk asset prices are rising, stock market is doing well. Thank you, Mr. Chairman. This is your reason why I'm feeling wealthier than I was a year ago. And isn't inflation going up? Is the price of milk going up and eggs going up? Hey, I have hundreds of millions of dollars of net worth. Do you think I worry about the price of milk? That is somebody else's problem. We are much better off with financial assets rising in valuation. So that, I think, is the reason why, again, the viewer asked about the common person's expectation. They are unlikely to be met in next week's meeting.
So here's another question, and interestingly enough, something that I was going to ask you about. This comes to us from Ben B, who wants to know, do the recent revisions to jobs data change interpretation of the overall macro environment? This is something that got a lot of buzz at the end of last month, I guess August 21st. These numbers came out, and we saw a significant downward revision in jobs data, some 800,000. I think a lot of folks who don't follow data as closely saw that number and said, well, gosh, I mean, if you overstated by almost 1 million jobs, how accurate is the data collection? Lots of questions swirling around that. How do you think about that revision to that number?
Clearly, we are not putting enough resources into accurate measurement, Ash, and that really is a tragedy. How can you come forth and say that the numbers are not being revised a little bit, but we are revising them down by about 800,000 jobs, which is a huge amount to do that over a year? That is an issue which is very difficult for the Bureau of Labor Statistics to deal with. Needs to improve that. Failing that, we don't have an alternative. So do we know again? Because I'm hearing that even though the 800,000 downward move in revision is what is being done, that may or may not apply to all the months going back. It may be particular months that may be in difficulty of measurement. So when you take all of that into account, it is not clear how much the revisions are, and if the revisions are themselves going to be revised again soon, and you may find out they did not overestimate the jobs by 800,000, but they overestimated only by, pick a number, 100,000. So I think, one, it is awful that we have this problem to deal with, but I don't have any ready remedy because we all work with the data that we have in hand. And when they are so inaccurate, we are all in trouble.
Sri, what's the challenge? What's happening over there? I've spoken to Bureau of Labor Statistics economists at the Department of Labor, and they seem as though they are obviously trying to do the right thing. I know there's been a lot of kind of conspiracy theories around this, but what's the challenge? Do they just under resourced? Do they just not have the resources they need to do the job they want to do?
I think that is the case. I don't believe in conspiracies there. I think the team is essentially apolitical in terms of their approach. They are not one party or the other party. But where the issue comes is they are under-resourced. They are probably not well paid. And if you are very skilled, you probably will not work there. And you will try to get a job in the private sector based on the experience you got at the Bureau of Labor Statistics. So I think resources need to be devoted to improving the quality. You need quality check more frequently so that when the number comes out, they get to be as close to accurate as possible. It bothers me not only that we had the 800,000 revision ash over the past year or so, but also in the last 2 to 3 months, the numbers have been revised down substantially, which again means that when the number comes out, the labor market comes out at the beginning of the month, 4 or 5 days into the new month, the market reacts that Friday quite significantly. But you may find out a month or two later that your reaction was inappropriate because the whole thing was wrong and it is being revised from, say, 100,000 up to 100,000 down. Then what do? The markets don't again react to it. The initial reaction was false positive, but that's what we have to go with. So I think, again, first of all, I don't think there's a conspiracy here. But I do think there is a lack of skill, a lack of ability. And one of the things I think about, since I think about the economy globally, my model on that is the government officials in Singapore, who, again, they are famous for the fact that they are paid extremely well in terms of comparison with the private sector, meaning that you can earn the equivalent of hundreds of thousands of US dollars working in a mid-level position in the government. So what does that mean? It attracts the best labor, the highest skills to come into work. And working for the government is comparable in scale with what you can get in the private sector. But here we have a big gulf between what the government pays you compared with what you can get in the private sector. And you're not going to attract the best talent. So that, I think, is the reason for what we are going through.
I mean, it's really hard to overstate the importance of these data points and the way that they get used by the Fed to determine these absolutely critical metrics for US monetary policy that have just massive, massive impact throughout the economy. I mean, it really does make you kind of scratch your head. And, look, I've spoken to these folks maybe a couple of times back when I was a CNBC reporter, and they always seemed incredibly diligent, like they were really focused on trying to do the right thing. But if you just don't have the resources, the data collection resources, whatever other resources you need, boy, it is just it seems like an underreported story that, man, this is really quite significant.
Absolutely. It is very significant. You simply cannot overestimate the problem. The problem is very large and something needs to be done very quickly about it. And again, I haven't heard anything being done to remedy it, but we do have a big issue.
Here's another question from Paul E., who wants to know, would either presidential candidate, if elected, be a positive influence on the U.S. economy?
Again, the two main candidates who are there, we don't know what specifically their policies are going to be, essentially because both of them are electioneering. And tonight we have the debate coming up. We may get a little bit more clarity, but I doubt it because I think they'll be playing to the audience. And what you see from either candidate tonight is not what he or she will do as president starting next January. Now, what I think is very important for them to do, but they will not do tonight, is to explain what they are going to do with the fiscal deficit. Normally, the fiscal deficit increases during a recession, comes down during an economic recovery, and that is the Keynesian stimulus and cutback that exists. And that usually is automatic and self-correcting. Here we have had the fiscal deficit increase both in dollar terms as well as a percentage of GDP. And that is taking place even during the US economic recovery. So what's going to happen during a recession if you haven't managed to control your deficit? So that's something first that they have to do. The estimates that have been made suggest that both Kamala Harris presidency and a Donald Trump presidency are both going to contribute to much bigger fiscal deficits. So the first thing that either would have to do is to recognize that higher fiscal deficit is a danger, it is a threat, and to be able to say what steps they are going to take to bring the fiscal deficit down and make the situation more conducive to steady economic growth. That would be the first part. The second part is in terms of improvement on the fiscal improvement of the labor force competitiveness on the global scale. You can't just do it by imposing tariffs, as again Donald Trump has said ahead of the elections. That is going to cause inflation to pick up, and that is going to cause again trade ruptures with both allies and competing countries. You need to find a way of improving the labor productivity, improvement there, rather than focus on tariffs. Those would be two major areas I would look at that the new president would have to focus on.
Well, Sri, for those who don't have gray hairs like we do, there actually was a time when there were deficit hawks in American electoral system. That just seems to have disappeared.
Yeah,
I mean,
absolutely. Go ahead. Sorry.
No, I just, it's something we haven't heard from either.
Yeah, we haven't heard that. And along with the deficit hawks, Ash, we used to have somebody who used to be called the bond vigilantes, who, when the deficit increased significantly, they would sell the treasuries, make the yields go up. And that was a signal to the authorities that they had to do something about it. But you wonder what has happened to the bond vigilantes, because the 10-year yield, as you pointed out in your chart, has come down substantially. And the 2-year yield has dropped even more since the beginning of the year. So much so that in the last few days, the 2 to 10 yield curve, which had inverted for more than 2 years, is finally positive again. All of that suggests to me that even the 2-year yield, 2-year paper holders are essentially anticipating the Fed to be very easy in the future policy, and there is no sign of a deficit hawk showing up anywhere in the picture.
Yeah, 2's10 spread has disinverted, my new favorite vocabulary word of the month. It's now 3 basis points positive. You mentioned U.S. Treasury yields. I think we have a chart of that going from over 5.2%, I believe, at peak, trailing 12 months in looks like October of 2023, down to where we are right now, 363 basis points. Big moves in 2-year yield. And there it is. There's the chart.
Exactly. And the reason that has come down is because in the world today, there is, among securities, there is no alternative to US Treasuries. We all thought Chinese renminbi denominated bonds would become a competitor. Hardly. China is in very severe economic trouble at the moment. We thought the Eurozone would come together, and Mario Draghi, the former head of the European Central Bank, made his recommendation yesterday that the ECB issue more common bonds to improve the competitiveness with respect to the United States, Japan, and China. And Germany is opposed to it. You need those to happen. If they were to do that, then European paper will become a competitor to US Treasuries. And then the US Treasury and the bond vigilantes will come out again in force to enforce discipline on the US side, but you don't have it. So what is the alternative that you have today? Gold. Look at the price of gold, how much it has surged since the beginning of 2024. And that says to me that the investors are saying all central banks are again running amok, cutting interest rates. So we need protection against inflation. We, all of us, global investors and debt holders, what we are going to do then is to switch over to gold. And that is the reason why the gold price has increased so substantially.
Yeah, 2,500, almost $39 on my screen right now, up approximately 70%, trailing 5 years. Big moves in gold.
Right. And up just this year from around 2000 to over 2,500, all happened in calendar year 2024.
Yeah, trailing 12 months up almost 31%. Year to date up about 22.5%. Big. These are big moves in gold if you don't follow the gold markets.
Yeah, I think there, again, going back to your deficit hawk question, Ash, I think the markets began by saying, we will give the US authorities a break. We don't have to switch over to gold right now. We may have a future in US treasuries. We may have a future believing the US fiscal authorities. What it says to me since the beginning of this year is the fact that the gold holders have given up any hope of the US authorities becoming more disciplined, and they have switched over for, all-time high to move into gold.
Times like this, we miss the great Pete Peterson.
Exactly.
Here's a question that comes to us from CH Ed, and the question is: what are Sri's views on whether the Fed will also announce the ending of QT, quantitative tightening, in addition to the 25 basis point cut next week? Hearing that this QT ending may be a nice surprise for markets, he asks as a question. And by the way, we should just show on the screen the total assets of the Fed. Important chart for you to see visually, just to get a sense of how fast, how much the Fed balance sheet has expanded since the global financial crisis of 2008.
Yeah, no, that's a great chart and a great question. Again, to remind viewers where we were on what I call Lehman Day, September 15th, 2008. The Fed's balance sheet was $800 billion, roughly speaking. At the beginning of 2020, meaning just before we recognized COVID, the Fed's balance sheet had already increased to $4 trillion, 5 times as much. Keep in mind that Ben Bernanke told us that quantitative easing was a temporary measure. Temporary? Really? 2008 to 2020 increases 5 times and it's a temporary move. When am I going to go back to the old level? Never.
It was temporary in the sense that it doubled again.
It doubled again in 2 years. Went from 4 trillion to almost 9 trillion. And right now we are running at slightly over $7 trillion. Look at it another way. We used to be less than 15% of GDP, the Fed's balance sheet divided by the gross domestic product, but that more than doubled since then. So if you think you need to create more cash in terms of reacting to a growing economy, you have also increased the size of the central bank relative to the size of the economy. And the question is, I don't even want you to go back to 4 trillion, let alone 800 billion again, but I want you to at least go back to the early 2020 balance sheet divided by GDP ratio, which I don't think is going to happen. And that says to me that quantitative tightening is badly needed. Having said that, the figure you come to is what happened in September of 2019 when we had a money market problem. Short-term interest rates surged, and the Fed immediately recalled that they went from quantitative tightening to quantitative easing overnight. And within the next 3 or 4 months, they had taken the balance sheet up to the November 2018 level. So in other words, we had lost about 1 year's worth of quantitative easing because that happened. Right now, the Fed is concerned still of that recurring, that happening. So when is quantitative tightening going to be stopped? I would say 2 possibilities rather than give a date. I would say if you have the slightest indication of a repeat of the money market problems, expect quantitative tightening to come to an end, with the Federal Reserve balance sheet still somewhere in the 7 trillion level. The second is the Fed has reduced the amount of quantitative tightening over the past year. That means even though the quantitative tightening has not reached its objective, they are doing it at a much slower pace than they did before. And that also says to me that Fed is getting ready to stop it at some point, just declare victory and walk away. If you don't win a war, the best thing you can do is to declare victory so that nobody, again, complains about you after that.
Let's just take a look at this on the screen. If we could just take a look at that chart one more time so people can visualize what you're saying there. If this is that gray bar, that very thin gray bar on the right side of your screen is the COVID recession. Obviously, it was a short but incredibly steep recession. What we're talking about now is that little roll off that you see. Obviously, when you look at this chart from call it January of 2020, you see it at around $4 trillion. You see it maxing out at around $9 trillion. This quantitative tightening is the roll down from that peak in July of 2022, around $9 trillion on the Fed balance sheet, down to where we are right now at around $7 trillion as of August of 2024. That's what you're seeing on that chart.
Those are big numbers.
Enormous numbers. And as you point out, and I think one of the challenges when you talk about numbers this big is that it sort of fries people's brains who don't spend their days in economics. But I think it's really important when you talk about the size of the Fed balance sheet relative to GDP, when you have a larger and larger percentage of the U.S. economy essentially existing on the balance sheet at the U.S. Federal Reserve, obviously challenges in terms of the broader economy.
Yeah, very much so.
By the way, I really loved your reference to Senator George Aiken from Vermont, whose solution to the Vietnam quagmire at the time was just declare victory and go home. I mean, it's a dangerous thing, I guess, for a central bank to do.
Yeah, it is a dangerous thing to do. But then the central bank exists to perpetuate itself. In my mind, that is the ultimate objective. So if you declare victory and you get enough people to believe that you have won, then you have another life and you can go on. One of the ways, again, that I have suggested to avoid this, we talked a lot about the Federal Reserve, Ash, and my recommendation, which again, until today has not been listened to, and I don't expect it will be listened to anytime in the near future, but I will make it anyway, that the Federal Reserve, despite what they say of being politically independent, I consider that very much a political entity. And one, essentially, even though the Fed chairman's term doesn't end at the same time as the president of the country, his or her term ends the year after. In the case of Jerome Powell, it ends in 2026. May is the end of the chairmanship of Mr. Powell. My suggestion has been that instead of the usual 4-year term that you have for the Fed chairman, that you have a single 6-year term and not renewable. So you are nominated as the Fed chairman for 6 years, not 4 years. And then you cannot be renominated, so you don't have to play political games in terms of policy. You are more likely to focus on inflation and employment. So that's what they ought to be doing, but that's not going to happen.
Sri, how about this for a t-shirt idea? Declare victory and implement the Taylor rule.
Absolutely. That would be a great t-shirt. The front and back of the t-shirt.
And the 150 people who would buy it are all watching live right now.
Very good. Good to hear.
Sri, these conversations are always our favorites of the month. And I know that our viewers, and I can see it by the flow of questions, feel the same way. We've covered, obviously, a lot of different topics here. As we come to the conclusion of this conversation, let me just ask you again, based on the trajectory of everything you see, what are your expectations for the next 6 to 12 months in terms of Federal Reserve policy, in terms of the broader economy, and in terms of risk asset prices in the US and abroad?
Federal Reserve policy, I expect continued cuts in interest rates, starting with next week. And the question is only going to be how rapidly they go. How far down do they go? Let's say now they are 5.25 to 5.5. Let's say that they are at 5.35 to pick a number as the today's rate. And it goes down to more like 3 to 3.5% in the next year and a half. That is what happens on that side. And on the risk asset prices, because of the sharp up and down of the interest rates, I do expect some kind of a credit event to take place. I've been talking about it for a while. Where does it come from? On the banking side, possibly. Again, a repeat, but this time not just smaller banks, but medium-sized, one or two medium-sized banks as well, which suffer a deposit flight. And the Fed is forced to intervene and cut interest rates in a hurry. In which case, immediately risk asset prices come down, but then they go up again. So if you were to tell me, take a photo shot today and compare it with where the risk asset prices will be a year and a half from now, I would probably say higher. But in between, you're going to have a dip, big dip, and the Federal Reserve eases, and then you go up again. Think about the change from September 2008 to March of 2009 on the S&P 500. The S&P 500 crashes after Lehman Brothers failure, but March of 2009 was a low point, and then with the Fed stimulating, you went up again. Those would be the two expectations for interest rates, for Federal Reserve policy. The economy, there might be very well a potential for a recession. Look at what happened to the 2 to 10 yield curve, and that tells you a story. Even though it has been inverted for a long, long time, usually the inversion lasts about a year to 15 months. This time we have lasted about 2 years and 2 months. But the more important thing to note, Ash, is when that re-inverts or disinverts, whatever expression you want to use, and it goes positive again, that is when the recession hits. And look at 2007, 2008. It went from being negative to positive around November, December of 2007. And the National Bureau of Economic Research has told us that the Great Recession began in December of 2007. So this could be a mild one. Just watch out for that. So the steepening of the yield curve doesn't mean it is hallelujah day for you. It only says that following the usual pattern, this may be where the recession is happening. So if that were the case a year and a half from now, since we are looking at that as the target date, you're probably out of a recession and you are in recovery. So interest rates much lower than where they are today. Risk assets take a big dip and then go up again. The economy, a recession, either mild or severe, but a year and a half from now, we are in recovery mode. And that would be my indication that you should go in for risk assets if you have a longer term time horizon.
Really interesting. Sri, I just want to follow up on one point that you made earlier. You mentioned the words credit event. My ears pricked up when you said that. I think you were on in 2023 during the period where we had a little mini contagion, I guess, in some of the West Coast banks, Silicon Valley Bank, some of the others that are no longer with us today, Silvergate, First Republic. There was this moment where there was real anxiety about what was going to happen in the banking system. It seemed to be quelled by action from federal authorities. And then we haven't heard much about it. It hasn't seemed to be on most people's radar. You mentioned some of and I think it's such an important point, some of the sort of the organic shift that we're seeing in demand for commercial real estate. I, like most people, don't have an office to go into any longer. This is just the way the world works. You take the train into Midtown Manhattan and you see those office towers and you wonder about the occupancy rates in those buildings. Just talk a little bit about this point, because the credit event risk, I think, is always the black swan that seems to be hovering on the horizon.
The credit event can, in my mind anyway, I have two major candidates where it can emanate from. The first one, as you mentioned, and let's start off from there, commercial real estate and the fact that you have a situation with much higher interest rates compared with 3 years ago. At the same time, as you mentioned, you and I not going to our offices and sitting at our homes and doing the work, much lower occupancy rate. So both of them come at the same time, and the real estate developers and the banks are hit from two different sources. Now, that could be one way it shows up. We did not show up in 2023 because until then, we had what is then called as the extend and pretend. The banks were able to extend it into 2024. They were able to tell you, I gave you a 2-year loan, I'm going to make it into a 4-year loan. So you didn't have to repay me after all. You can repay me after the next 2 or 3 years. Therefore, you are not in default, and I don't have to declare that my loan is impaired to you. So the reason why that is failing or going to fail is that since the beginning of 2024, Ash, the number of transactions in the secondary market has increased significantly. In other words, I bought a building for $100 million in pick a date, June of 2019. So that, let's say, pre-COVID high. And that building I bought for $100 million, I kept thinking it'll go back to that price, but it doesn't. And if today I were to sell it to somebody else for $40 million, taking a 60% hit, and some of those have happened in key cities. It has happened in Los Angeles, San Francisco, New York. These are three places where the discounts are quite large. If you sell the building at a huge discount, and many of you do that, I am holding on to a building still valued at $100 million. I can no longer extend and pretend that it is worth $100 million. The comparison I would give you is the fact that I started my career with Latin American debt in the 1979-80. And for many, many years, with the connivance of the US Treasury and the Federal Reserve, the largest US banks considered their loans to Mexico, Brazil, Argentina, all at being at par, even though those countries were not able to make interest payments. What essentially brought this whole charade to an end is the fact that there were lots of secondary market trades of the debt. And they were trading at 40 or 50 cents on the dollar. And the banks could no longer pretend that the loan to Mexico is still worth 100 cents on the dollar. That's the same phenomenon I anticipate with respect to office space in the United States, that somebody would come and bring reality into it and say, you can't value it at par, you have to value it at a discount. And that again causes a few institutions not to be able to take that hit. And that is where one credit event can come from. Second, related to it, the smaller and medium-sized banks are the big lenders to commercial real estate as a percentage of total assets. It's not the largest banks that are the big lenders, but the smaller banks who are the lenders. So that is where you see the problem going from commercial real estate to bank viability. And that is the second area where it's going to come from. Third, the banks believed Jerome Powell when he said inflation is transitory in 2020, 2021. So what did it tell you? If you bought 10-year treasuries at 2% at the beginning of 2021, you thought that by the end of 2021, 2022, if you bought it at 1%, it is going to go down lower in yield and you're going to make a big capital gain. Instead, it went the wrong way. The yields went up, you lost a lot of money. And that is part of the problem the banks are running, and the bank assets, a significant chunk, are still underwater. And when they start to recognize it, and if there is another deposit flight from some institutions, that is going to cause the Fed to intervene. And that is, again, another area for a credit event to take place.
Sri, this is such a big and important topic. There's only one thing to do. We've got to have you back to talk more about some of the underlying risks in the credit system here in the United States. Always a thought-provoking conversation, always something I know our viewers enjoy. Komal Sri-Kumar, thank you so much for joining us.
Thank you very much, Ash. Great discussion, and I appreciate your questions.
Thank you, and thank you for watching. Thanks for listening. Have a great day, everybody.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.